the United States will implement reciprocal tariffs on
Global financial markets are tanking again.
Technology shares on Wall Street have fallen
President
sharply.
Trump has announced a 90-day pause on tariffs against most nations while raising tariffs against China.
We've had a lot of news this year, a torrent of executive actions and tariffs, DeepSeek's disruption of the AI narrative, and a shift in defence and infrastructure spending out of Germany. As a result, we've seen significant divergence in performance across and within equity markets, as well as a new, weaker trend in the US dollar. We need to take a step back to get some perspective. Since the 1990s, Western policy focused on fiscal rectitude combined with loose monetary policy and a highly globalized economy. The challenge with this model was that it didn't work for the majority of people in Western democracies. As a consequence, in recent years, we have seen the emergence of a new populist political consensus focused on a more proactive fiscal policy, protectionism, and anti-immigration. This might appear like a chaotic combination of events, but really it is symptomatic of a deep-rooted shift in the political consensus that we've been outlining. So what does this mean for markets? First, higher fiscal spending boosts nominal growth, which can be helpful for equity markets. Indeed, a lot of the outperformance of US equities over the last couple of years was driven by the ability of the American government to outspend other Western governments. Similarly, the news on the release of the debt brake in Germany has driven strong outperformance of European equities. The ultimate constraint on looser fiscal policy will be the consequences for inflation and higher debt levels, and the willingness of bondholders to accept this. If debt levels are seen to be unsustainable, or if the commitment of policymakers to some form of fiscal responsibility and inflation control is questioned, we could see yields on bonds rise. This could draw money away from the stock market and increase corporate borrowing costs. For now, we judge this risk to be low. Central bank independence is still intact. The Trump administration is focused on cutting government spending, and German expenditure will take a while to come through. Which brings us on to the T word, and here the news is less supportive of markets. Certainly Trump's opening salvo points to much higher tariffs than we were expecting, and we're revising our growth forecasts downwards. This leads us to temper our positive view on equities, and we see value in government bonds as a hedge against the risk of recession, possibly for the first time in this cycle. We continue to like gold as it benefits from both weaker growth and the more structural risk posed by rising debt levels. But let's also try and tease out some positives. Trump's framework is now clear and provides a starting point for negotiation. Now the reaction function of the rest of the world will be critical. The countries on the list are making their decision to either retaliate and escalate the war or contemplate reducing their trade imbalance with the US. At least we're starting to understand the rules, and this gives the markets a basis for pricing risks. Lastly, let's focus on the US, where the extreme concentration of the S&P 500 in just a few companies exposes investors to a higher level of stock-specific risk, as the recent DeepSeek news demonstrated. As a result, we've been diversifying our equity exposure out of the US